All eyes down for a big week of negotiation. Sounds like the Chinese might have the Americans on the ropes or slightly on the run. Your take on the latest salvos this morning. Welcome.
Thanks for having me here this morning. Look, there's been a bit of a cat and mouse game going on for a while here now. So you'll have a bit of a olive branch, and then you'll have a little bit of a parry. So I don't think that this is anything more than the rhetoric that we've seen over the last several months.
As that rhetoric continues and people are sort of saying, look, we should hunker down for something slightly longer, more enduring and less stable. With that in mind, is the bastion for you, I want to be long American equities, I want to be long the dollar relative to the rest of the world if we're hunkering down for a longer term fracas?
Look, the main reason to be long U.S. right now is that the U.S. economy is still doing pretty well relative to the rest of the world. And so that's reflective in, capital flows being interested in U.S. assets. So that continues to propel U.S. markets. But as you say, anything that continues to weigh on that suggests that this is going to deteriorate into a broader global recessionary impact, which ultimately would pull the U.S. down with it. Any of those things are things that are going to make investors very nervous in this environment.
My last guest, Lori, have a look at this. It's in the GTV library, opposites attract. I'm talking about equities versus bonds. Look, undoubtedly, the bond traders really had the narrative, didn't they? I think the phrase that my last guest used, the bonds were winning control of the narrative. In other words, the yields really were beginning to turn quite aggressively lower. The shorting has reduced. What happens next in this story in regards to the bond market, Lori? Do we see lower yields in the near term?
Well, we think that the bond market, at least in the U.S., has it a bit wrong in the sense that yields on the 10-year at 1.5 are not consistent with an economy that's still growing north of 2%. Our forecast is that 2019 will be about 2.3% in the U.S., and even 2020 looks pretty good at about 1.9. So it seems as though rates at 1.5 are lower than they should be. On the other hand, when you have zero interest rate policies in other geographies around the world, the U.S. is pretty much a safe haven. It's a place to put some capital and get at least a little bit of return. So we think that that's a lot of what's driving the lower yields, at least on the long end.
We just caught up with Jeffrey Yu there, and I said to him, was Thursday a pivotal moment? If you look at the slate of data card last week, manufacturing, services, and a less than effusive jobs report, even though the rate of unemployment is at a 50-year low, wages were a bit dubious. I asked him, was it a pivotal moment on Thursday? And he said to me, it mightn't have been a pivotal moment in terms of the markets, but it might have been a pivotal moment in terms of the Fed chivying them along to do a little bit more. You say the case for pause is building. Have a look at the rates market and tell me why you think the case for pause is building.
Well, look, we still think that the Fed may move one more time this year. We don't think that it's going to be October. We think it's going to be more like the end of the year, December. But really, the Fed has said repeatedly that they're going to be data dependent. And when you look at the data, at least in the U.S. economy, the consumer health is quite strong. And about 70% of the U.S. economy rests on the shoulders of the consumer. So you've got an employment number that came in, not, knock your socks off, but it was also a number that had reasonable backing. We had some improvement in the past, jobs growth. We still see, hours worked being pretty good. So there doesn't seem to be anything on the horizon that suggests that the consumer's going to crack. So as long as that doesn't happen, there's no reason for the Fed to get into a bit of an emergency mode here.
OK, and you've got some tactical calls in terms of credit versus duration. Now, one or two people have sort of said to me, look, Manus, what maybe I'm missing is that the scale of taking those duration trades off has been quite substantial. So when you say you prefer credit to duration, just talk me through that.
Yeah. So again, as I mentioned, our views are that 10 years at 1.5 just doesn't seem consistent with the kind of broad growth backdrop that we have in the U.S. On the other hand, even though we're late cycle, we do believe that the low interest rates enable companies to continue to finance and continue to have their own operations do well here. So, at the margin, we think investment grade looks better than treasuries because you're picking up a little bit of income there. At the margin, we like the certain sectors of the high yield market. Here again, a nice sort of a balance between a large overweight to equities versus versus having a little bit of our equity exposure through high yield credit. So we're trying to be very selective in here. We're trying to stay focused on quality, but we are looking for those places to get incremental return above just the risk-free rate.